Red Cloud Financial Services is your preeminent source for mining industry opportunities. The team provides a unique, tailored marketing program dedicated to reaching the right people from its mining-focused global network, giving clients access to industry-leading events and conferences, retail and institutional marketing, plus an in-house growth-driven digital agency. Red Cloud Financial Services has access to some of the mining industry's most notable companies and CEOs.
Well, looks like we're live. Thought we had another 10 seconds to go there, but welcome to another live core conversation brought to you by Red Cloud Financial Services. I am Mark Bunting. I'm your host, and I'm the host of RCTV. Today, the topic is the art of investing in physical precious metals. So we'll be taking your questions. Just drop them into the comments section, and we'll get to as many as we can, probably towards the end of the show. Our guest today is Eric Larkin. He is a senior advisor at McAlvany Precious Metals, and he joins us from Durango, Colorado. Eric, let's bring you in here. How are you, sir? Thanks for joining us.
You bet, Mark. Great to see you. Thanks for having me.
You as well. Now, full disclosure off the top, I was first introduced to you by way of Hedgeye Risk Management, where I'm a subscriber to their research. They were looking around for a preferred precious metals dealer. They vetted everybody they could, and they settled on McAlvany Precious Metals. So that is high praise. And Eric and I were on the phone recently, and I actually pulled the trigger on buying some physical silver, and I'm keenly awaiting its arrival. It's the first time I've actually bought physical. So this is going to be an education for a lot of people, and for those who already invest in physical precious metals. Maybe you've got some at home in a safe. You'll still be learning today, because this is going to be really interesting on the ins and outs, the hows and whys, and so on. So having said that, Eric, could you start with a snapshot and a brief overview of McAlvany Precious Metals? There's an interesting history.
You bet. You bet. We are one of the oldest precious metals brokerage firms in the country. We were started in 1972 by Don and Molly McAlvany. Funny enough, if you know your precious metals history, starting a firm to sell bullion in 1972 wasn't quite legal. Don actually found kind of a tax loophole to be able to sell religious relics, if you will. So he would take pieces of gold and inscribe, scriptures and stuff like that, and was able to start his business that way. So we've been doing this a long time. And one of the things that we really strive for is to just kind of take a different approach of compounding your ounces over the long term. And also, as you mentioned, Mark, we kind of met through Hedgeye, and one of the things that's very important to our firm, and especially to me, and is Keith's top three things, right, is trustworthiness, accountability, and transparency, right? So that's kind of how we kind of meshed and clicked, and now here we are. Yeah.
Right. You're referring to Keith McCullough, the founder of Hedgeye, a good Canadian boy from Thunder. So definitely worth checking him out. Follow him on Twitter. And so on. And Eric's on Twitter as well. So, Eric, you've joked before that you're kind of like a 1980s stockbroker, because you're on the phone all the time. Very old school. So can you sort of define and describe your day-to-day role?
You bet. Yeah, it's a very reactionary role, right? And it is spent on the phone most of the time. Lots of new clients, we usually try to schedule consults with them, right? Just to kind of really block out a time to get to know them. But other than that, we're watching markets, we're talking to trade desks, and I'm answering the phone all day from existing clients, potential clients, all of it. It is on the phone. We're in constant communication with all of our wholesalers and their trade desks, because we don't have the ability to just kind of plug everything into the Bloomberg terminal in this world. So it is, from what I've heard, I mean, I was born in 1988, so I kind of missed the 80s stockbroker life. But from what I get told by all of my clients who did live that's exactly what I'm doing. And I enjoy it. It's fun.
Right, of course. And you've seen Michael Douglas in Wall Street on those big old phones. So you know what it's like. So exactly.
A little nicer now. We got, we can just throw the AirPods in and kind of walk around. I'm working from as my coworkers like to call it, the land yacht today. I'm in my Airstream on my property out in the mountains, and this is kind of where I hunker down and get it done.
I like it. Very good. Now, you talked about compounding your clients' ounces, and a lot of that has to do with the gold silver ratio. And you've been good enough to provide us with a few charts. One of them goes back to 1975. It's really interesting. So, can you tell us how you incorporate the gold silver ratio and what the overall investing philosophy is at McAlvany?
You bet. Our end game is always going to be more ounces of gold, right? Gold is the ultimate metal that we want to own. Silver is much more volatile. So we do use this gold silver ratio to help clients compound our ounces. And this ratio also shows us, which metal is either undervalued or overvalued relative to the other metal. So you can see on here just the red line that's kind of moving. That's an average. That's the average gold to silver ratio from 1975 to present. And that is currently right at about 63 to 1. We're currently trading about 85.5 to 1, which heavily favors silver, right? So what we do in a time like this, and I don't love silver. I'm no silver bug. It's volatile. You can get buried with it, right? You can make great money on it as well. But unlike gold, it's not just this steady store of value. It has wild spikes. You could have purchased silver in 1980 and paid $50 an ounce, right? Anybody who bought gold in 1980 is up substantially. So that's how I look at silver. And we look for these outlier events. One that I can just see so easily on here was 2020. The spike in the gold silver ratio you can see there went all the way up to 126 to 1. That's not a normal thing. That was on the news of the COVID shutdowns and the global economy shutting down. Those are the times when we can really, show our value. When that ratio spiked for our existing clients, we sold anywhere from 30 to 50% of their gold on that spike and moved into silver. And, less than a year later, when we came all the way back down, you can see where we tagged that black trend line. We swapped out of that silver and into gold, and they had, it was anywhere from 35 to 45% more ounces of gold than they would have if they had initially just purchased on that spike in the gold silver ratio into gold rather than silver. So that's one of the ways that we really look at how to use this to help compound ounces over time in a long-term precious metals portfolio.
I want to get back to those outlier situations. You've got some really interesting stats on that going back about 25 years, specifically with silver. But you give a good example of clients who have been with McAlvany for, let's say, about 25 years. They committed X amount of dollars initially, and they haven't really put any more dollars into their investment. And yet they have about 4 times more gold than they did initially. So that's a good example of the back and forth and the compounding of the ounces, right?
You bet. Yep. That was one of the better ones we've had too, just because the duration was so short, right? We had that extreme of 126 to 1, and I don't think I caught anybody at exactly 126 to 1, to be clear. I have a handful of examples right at about 110 to 1, where we quite literally sold 30 ounces of gold, moved into 3,100 ounces of silver on that spike. 9 months later, we sold the 3,100 ounces of gold and moved into 45 ounces of, sold the silver and moved into 45 ounces of gold. So massive gains in ounces in a short period of time. And then all of our clients had, 30, 40% more ounces of gold before it went, spot price went from $1,900 to $2,700. So a lot more ounces for this move up.
Now, Eric, you're also looking for mean reversions, and so these outlier days that you're talking about, going back to 2000, you've got some really interesting stats. There's X amount of trading days, and the ratios, gold silver ratios, only hit 90 or 100 or more, really not that many times. So, can you run us through those?
You bet. Yeah. One of the first levels we look for that favors silver is about 80 to 1, right? So that's when we might start taking a small position. If you're establishing a new portfolio and the gold silver ratio is above 80 to 1, I'll definitely recommend a silver position, even if your goal is just a long-term gold hold. 90 to 1 gets a little bit interesting. Yeah, we have not spent much time above 90 to 1. It also has acted as a bit of a price indicator for us. We don't solely rely on it or make large bets on it, but it has proven that, the last 3 or 4 times that silver tagged 90 to 1 on that ratio, which just shows us that silver is undervalued relative to gold. Following that 90 to 1 tag, 6 months later, the spot price of silver was up anywhere from 30 to 65%. So it doesn't like to get above 90 and stay above there for long durations, as you can see on this chart. There's not much time that's been spent above there. I have some notes right here, and I can tell you that just from 2014 to January of 2024, we spent more time between 70 and 80 than anywhere else by far. Our time spent above 90 to 1 was about 20 weeks in total over a 10-year period of time. So those are one of the levels that we're really looking for. And then the extreme, right, is anything above 100. That's only happened twice, once in 90 and then the other time in 2020. So that's a big move.
Eric, one of the other charts you bought goes back to about 2011, 2012, I believe. And my eyes are not good enough to see if we're showing that just then, or was that the 1975 chart?
I was looking at it the same. I think that was the 1975 chart. If you pull up the other one, Jonathan.
Yeah, here we go. What do you want to tell us about the trend line?
Yeah, that trend line's just I might name it the Larkin line here soon if it continues to play out. But in 2011, and again, this is just the gold silver ratio, but the exact date that we created this trend line, that first tag there, we did it again in 2021, and then again in May of this year, which actually it's kind of been busted. But each one of those tags on the trend line represented a cycle high in the silver price. So to the date, when we hit that spot in 2011, that was the peak of silver. 2021, it was the same thing. And then I think it was May 20th of this year when silver first kind of broke out. It got to about 32.50 and then failed back down for a while. We've now recaptured that. But it's just showed significance that the gold silver ratio, if we can break below that, we might be able to make some substantial trades down there. But it likes that trend line and it's respected it for now.
Right. We know in 2011, as part of that trend line we were looking at there, that was when silver nearly hit 50 an ounce and then had a sharp retreat after that. And we also know, as you said, it hits that trend line and then will bump its head around 30 or so and then go back down. But it did break up to 35 several weeks ago. It settled back down below 32. I'm not asking you to forecast or anything, but do you have any thoughts on the recent activity in silver?
Yeah, that level that we kind of failed at, I don't have it exactly in that 35 range. That's been an important level going all the way back to 2011. I can actually take it even further back to that 1980 run where it's just proven to be a sticky area. Same with right around 29.72, which I think we might go touch again. That for some reason those price levels have been a magnet for the last 13, 14 years from that original breakout. 29.72 in particular, we just continued to tag and tag and tag. I don't speculate too much on price mark because I'm simply just not smart enough. And there's others, we mentioned Hedgeye and Keith, the amount of inputs and data that they have to kind of forecast these things are far greater than what I have. And I think it's also important to note that I sell these for a living, right? So me telling you, silver is about to go to $50, I might have some incentive there, right? I work a commission-based job. I think one of the things Keith said when he was interviewing Michael Cabinet, probably botching that name, but the reason for almost everything is how someone gets paid, right? And I think that's very important to remember. And one of the things that I tell my clients frequently is it's probably not best to get price predictions from a person who's selling you that exact thing. I think it's wise to look elsewhere for those inputs.
And it's worth noting, Eric, that the traders here and the team here at Red Cloud, they're all always looking at their own levels, and they have their formulas and techniques too. So worth keeping that in mind. So as you said, the gold silver ratio currently around a little bit more than 85, and every investor is different, as we know, in terms of risk tolerance and age and how much money they want to commit and so on. But just hypothetically, if somebody came to you and said, okay, Eric, I'm all set. I want to buy more, or I want to get in for the first time ever into physical precious metals. What sort of makeup of that 10,000 would you recommend? You mentioned you're favoring silver right now.
You bet, you bet. But remember that the end game's always going to be gold. The ratios just got me favoring silver. For the average person, it would be roughly uh, a minimum. I would tell them that I would take is about 20% in silver. I would not go above 35, 40% in silver just due to the volatility. But the other thing with my job is that I have to wear a lot of different hats. There's a lot of different reasons that folks are buying precious metals, especially physical precious metals. Some clients exclusively want it within their grasp, right? Somewhere where they can reach it. That's kind of their whole purpose for buying physical precious metals. If you don't own it, or if you can't touch it, you don't own it, kind of deal. A lot of our clients have no interest in ever touching it, right? They store it at the depository, or maybe it's done through an IRA, so it has to be stored at the depository. So it really depends for anybody. Everybody's kind of case by case, but if you're just giving me carte blanche to use our strategy, then I would be right now at 85 to 1, anywhere from 20 to 25% in silver on the front end.
All right. Now, that leads me to my next question about people who want to touch it, who want to feel it, and keep their physical gold and silver at home and in a safe, presumably. And again, every investor is different. But you've said before that nobody needs something like, let's say, $500,000 worth of physical gold and precious metals at their home. So is there sort of and again, it depends on the person, but is there sort of an optimal percentage of a total physical gold and silver portfolio that one might want to keep at home and the rest with the depository? Is there a formula or ratio there, or is it just up to the individual?
It's really up to the individual. My personal opinion on that is that nobody needs, $500,000 worth of gold in your house. But at the end of the day, it's whatever helps you sleep best at night, right? And if that's having $1 million or $500,000 worth of gold under your bed, then kudos to you. For me, it's, why do you want to have physical gold at your house? Do you think the world's ending, or could possibly end, where there's going to be a potential that you're going to need to barter with it? Then you need to work out kind of your budget and what amount you want to allocate to having that at home. If you're just wanting to, I think in kind of your case, Mark, it's more of it's just kind of neat. It's something you've never dealt in. You want to show your kids and grandkids, sound money. It really is case by case. And the only difference for us, and it doesn't matter to me where you store your metals, but if you're participating in our strategy, and we're going to be, selling silver for gold and vice versa, or coming out of certain products based on a premium, then you need to know that you're going to have to pack that stuff up. You're going to have to ship it. There's cost in that, and there's a lag time. So it's more of an inconvenience that way, but really some folks just feel a lot better having it in their possession.
Eric, as we know, there are a lot of narratives around gold and silver, a lot of emotions involved, a lot of people very regimented in terms of their thinking, and so you really encourage your clients to get their emotions out of the equation when they're investing in physical precious metals, and it really just comes down to the data, the supply and demand, premiums, gold silver ratio, and remove your emotions. But is that a hard message to get across sometimes to people?
Oh, definitely. Because, this is one of the more emotional assets out there, right? A lot of times, uh, buyers are strictly driven by fear, right? And one of the worst things that's happened for for the gold industry, and it's great in a way, but is YouTube, right? The amount of clients that get down the YouTube rabbit holes and think that they need to, liquidate their entire retirement accounts or pensions and put it all into coins that they take in possession. Those are the narratives that really get to me. So I just try to stay calm, let them know that, regardless if the world ends or not, I can't get those metals to you by tomorrow anyway, whenever what event is going to happen. And the most important thing, Mark, is just knowing what you're buying when you get into the physical market. So many people point you like, hey, buy gold. Gold's a great thing to buy right now. And then folks are just kind of left with like, okay, I can go buy an ETF, or if I buy physical gold, what do I do? And 9 times out of 10, they call a number they saw in a commercial, and they get a dealer who, this is a nightmare industry. If I'm being honest, it's unregulated. There's a lot of bad actors, and that's the most important thing for me, is just know what you're buying, know what to ask your dealer, know what their commissions are, what they're charging you, because a lot of people who are afraid to, they've spent their whole life working, blue collar folks who have always had a fear of investing in the stock market because they've been taught that it's rigged and it's fake. So they've sat in cash and accumulated this life savings for their whole life, and then at some point they got this thought in their head that they have to put it all into gold, and they go to these gold dealers, and I've quite literally seen, and it's almost always older folks, little old ladies and substantial amounts of money. I've seen companies charge them 50, 60, 70, 80% commissions, to where their retirement accounts are quite literally cut in half overnight, and there's no getting it back.
Well, that's pretty frightening to hear those kinds of stories. And that leads me to this question, which I'll preface by saying that's part of the reason I steered clear of buying physical all these years. Number one, it wasn't a huge priority, but when I would think of it, I just felt I'm a neophyte. I don't really know what I'm doing. If I go to a bank or a dealer, they're going to rip me off on the premium. So that sort of kept me away. So what are some of the red flags to look for? And second part of that question, Eric, is why is it a bad idea to store your physical metal with the dealer that you bought it from?
You bet. Yeah, great questions. As far as kind of the tactics that and things to look for, it's almost always the same story. I've got a running list. It's I don't know if you remember the old show America's Most Wanted, but I stole their logo, I put it on a Word doc, and I've just got a list of dealers that are on my most wanted list. And the interesting thing, it's like they all went to the same training. They do the same thing. They sell coins that are typically, funny enough, usually Canadian coins, wildlife type coins that I've never even heard of, but they typically never sell just 1 ounce coins, right? Because it's very easy for the consumer, the client. If silver's $30 an ounce and you're buying a 1 ounce coin, it should be somewhere around $30, right? But they sell 1.25 ounce coins or 1.5 ounce coins of silver. And then on the gold side, they sell 1/4 ounce coins. And then they give you a really good story about how they've got a special from the mint, and there's just this limited amount of these coins, and there's going to be this massive spike in premium on these coins. And they mark them up quite. I mean, I do the math on all of these clients who call me, and we have to kind of unwind these trades. And I mean, the most recent one I did was the buy trade was from 2019. So I think spot was somewhere around $1,700 an ounce. And they bought these 1/4 ounce coins for $1,000 per coin. So, I mean, simple math right there. They paid $4,000 an ounce for their gold. Now, these coins have no intrinsic value. They're not collectible. They're quite literally bullion. So they're worth melt. They're worth the melt value in that coin. That client will never get their money back. It's not going to happen unless gold ramps to 4,000, at which point they'll be break even. So I always advise clients to just stay in very common products that you really know, and then just ask your dealer, okay, how much money are you making on this? What are your commissions? What is the bid ask spread? If I buy this from you today and sell it tomorrow, how much is it going to be worth? And that question alone, if they give you a truthful answer, is horrifying. Sometimes it's 20, 30, 40% less.
All right, good advice, Eric. Buyer beware. Now, shifting gears here, gold we know has been a currency for millennia, and so has silver, although less so now. It's more so treated as an industrial metal, and it doesn't always work. So, can you explain to us how investors, and that's something else they need to layer in to their thinking, is what is economic growth doing? Is it accelerating or decelerating? Is inflation accelerating? Is it decelerating? As to when the good time to buy is, and when do you want to kind of step back and wait, or maybe sell?
You bet. And that's the other reason why our end game is always gold, right? It's the currency, it's the store of value. Silver, along with the volatility, you're right. There's so many other inputs for silver on an industrial level. And I think that when it actually comes to the investment side that makes up what is, the actual silver market, it's very, very small. In comparison to the industrial side. That's something that the Red Cloud folks and your mining guys would know a lot more about than I would. But definitely the most important thing. And again, Mark, if I'm just being fully honest, that question is like exactly what I use Keith and the Hedge Eye guys for with the quads, because I use their quads for when it's time for gold or when it's time for silver. That's not the best answer, but it's quite literally true.
Right, and we don't really have the time to go into the quads, but it's quad 1 through 4, and basically it's Hedge Eye boils it down to, is growth accelerating or decelerating, and inflation accelerating or So currently we're in quad 3, as they call it. Inflation is accelerating, growth is kind of slowing, not going to zero, but it's slowing slightly. So this is a inflationary environment. We've seen bond yields rising, U.S. dollars going up. Gold had been doing well pre-election, and silver as well. So that's essentially what Eric's talking about when he talks about the quads. All right, Eric. So let's say somebody comes to you, be it a Canadian investor, American, wherever, and they say, okay, I'm ready to go. Can you just sort of briefly walk us through how that process would work if they wanted to be a buyer?
You bet. You bet. So one of the first things that I'll ask you, as I did with you, Mark, is are you wanting to take possession of this or have it stored? Depending on that answer, if it is a storage account that you'd rather have, we will help you set up the account with the depository. Something that I missed earlier that you asked me to touch on, Mark, why you shouldn't buy from a dealer who claims to store for you as well. We've never stored for clients. We could if we wanted to, but we've always used a third party depository. The reason for that being is that there have been a handful of companies over our history who claim to store the metals that they're selling you, and it's a complete Ponzi scheme, right? They simply don't have the metals that they're selling you. This is happening right now with a company in California. Current lawsuit going on. It's a nightmare. They had been selling metals for well over 2 years that they didn't have. So that's a big one. Sorry, I didn't mean to get sidetracked on that. But if you're wanting your metals stored, it's a simple one-page application. Once the storage account is open, we can execute a trade. We simply ship the metals to the facility where your storage account is, and they put them in your account. If you are wanting to take delivery of the metals, very easy. I just need basic demographics, where you want the metals shipped. You can either send us a wire or a check to get funds on account. Once the funds are on account, we execute the trade, and 2 to 3 days later, you'll get some tracking info, and they'll be headed your way, either FedEx, UPS, or U.S. Postal Service.
All right, and you're based in Durango, Colorado. So for a Canadian investor, what are the benefits, and are there any drawbacks of saying, yes, Eric, I want to buy physical, I want to store it at your preferred depository, or should I keep it here at a depository that you have a relationship with in Toronto or Calgary or Montreal or wherever?
Yep, no big drawbacks. The only difference, if you're a U.S. citizen, you live in the U.S., and you have a storage account with a depository, you can actually request shipment from there, and they'll ship it to your U.S. address. You can also set up an appointment and go, pick them up physically. That would be the only drawback. They won't ship it internationally, so you couldn't request your metals from the Delaware depository to be shipped to Toronto. That wouldn't be possible. You could still come to the U.S. and pick them up, but that would really be the only drawback. I would say the downside to storing them in Canada, with working with me in particular, is that we don't have the same relationships with Canadian dealers and depositories that we do here. So, all of my wholesalers work with the same depositories as us, so everything is very liquid and very fast. It might create a little bit more of a time if it was a Canadian depository for us.
You told me over the phone one time, Eric, that you had a client, or McAlvany had a client, and they literally had 30 million in physical gold, I guess it was, somewhere in Europe, and it took them 3 years to get it back.
Oh man, yeah, that was my client actually. This was 2017, I think, and it was a yeah, it was a substantial amount of money. At that time, I think it was valued at that, so it's probably double that now. But yeah, she had stored the metals in Switzerland and wanted to, get the metals back stateside. So we, started the process, and her metals got held up in Swiss customs for almost 3 years. She got it all back, and everything was fine, but it was literally a 3-year process of just jumping through hoops, and it was a nightmare to the point where I I don't tell folks not to store internationally anymore, but I do tell them that that has happened to me in the past. So just to be aware of it, I've never had an issue. We have a lot of folks who do store their metals in Europe and other countries. And we've never had an issue because we can always liquidate those metals even when they're over there and just turn it back into dollars. And that's never been an issue. But actually physically getting them back into the US in this particular instance was a nightmare.
Well, luckily for her, during that 3 years, the gold was going up. So everything worked out well for her. A happy ending after all. So is there anything we haven't touched on, Eric? Anything you'd like to discuss that we haven't really hit on?
I think that the most important thing for me is that you don't buy based on fear, right? Or some really good story. It's important for you to kind of know what you want before you contact a gold dealer. That's one of the things that I'd like to really harp on, Mark. I have seen so many people get burnt in this industry, and I've mentioned it, but there's so many bad actors, and it's got such a bad name, and rightfully so in a way. So I would just say use caution. It's a great market, and we can produce great alpha in this market, but you have to know who you're working with, and just be very careful. As safe as everybody will tell you gold is, which it can be one of the most dangerous things to enter the physical market with the wrong company or the wrong dealers.
All right. Sound money, sound advice from Eric Larkin. Thanks so much for your time today, sir.
You bet. Thank you, Mark. Thanks for having me, and I look forward to keep chatting with you.
For sure. We really enjoyed that and the education as well. Eric Larkin, Senior Advisor at McAlvany Precious Metals out of Durango, Colorado, right from his Airstream. How about that? You got to love today's technology. Thanks a lot for joining us. This will be up on YouTube later today. The Art of Investing in Physical Precious Metals. We'll see you next time. Take care.